Today's guest is Scott Schindelar, a geologist turned real estate investor. Scott began strategically leveraging his income at age 23 with a fourplex, eventually amassing over 100 residential units, co-owning a real estate co-worker space, a property management company, and releasing his book, The Millennial Map to Millions in Real Estate. Thank you, Scott, for joining us.
Thanks for having me, Jesse.
So, Scott, the name of your book is The Millennial Map to Millions in Real Estate. What was the inspiration for writing this book, and briefly outline the strategy?
So it's funny hearing anybody say the name, because as soon as you hear it, you realize, man, this guy doesn't do marketing. He shouldn't have made the name so long. So I literally wrote the book because in my little town, I have people ask to pick my brain very regularly. Can I take you to lunch? I'd like to ask you some questions. I want to pick your brain. Can we do this? Yeah. Can you come look at a property? I'd love to pick your brain. It happens all the time. And it takes a lot of time out of my day. I'm all about helping. I love the educating portion. I love, setting other people up for success. So the big portion of the book really was not to sell a ton of copies of the book and market it across the board, but was to be a referral guide to all of these people that are always asking me questions to start somewhere. They ask, what book should I read? What would you read if you're in my position? And, I love giving referrals for books, but what I wrote really hones in on what I like to do and what advice I would give somebody, and helps that person then ask me good questions instead of asking really broad questions.
I've read maybe 150 quote unquote business books or entrepreneurship investment books. And I enjoyed yours because you actually laid out the plan of how to go from step one to, step 100. And I know you mentioned Robert Kiyosaki, who actually, it's one of my least favorite books, The Whole Rich Dad Poor Dad. I think that could have been like a magazine article, but where you basically actually just lay it out. And some people would consider your strategy kind of the buy, borrow, die type strategy. I know like Ken McElroy Ken McElroy? Yeah, he's one of the advisors to Robert Kiyosaki. He has some good books and a very similar strategy. But what is your strategy? I mean, when you're 23, you basically bought a fourplex, you lived in one of the units and fixed it up and then went around to each unit. But take us through from day one of your real estate journey.
Well, it's funny that my real estate journey really didn't start in real estate. I got out of college. I had a couple good job options. I saved up as many dollars as I could, as quickly as I could. And I got to around $10,000 in the bank, and I gambled on a presidential election thinking it was a good place to stick some money. I thought oil and gas was going to do great after, so-and-so got elected. And I found a good stock with low debt and low growth shares, and, dumped every dollar I had into it. And the next day I had half my money left. It was a matter of a day. I lost half the dollars I had saved in the, first 4 months or 6 months I've been working. And that hurt my feelings. I realized I needed to have control. I should figure out how to have control over my investments instead of just, gross speculation. And the easiest path that I saw was in real estate. And, if you start looking at statistics and start reading, really, there's just so many things to back up the securities that come with it, the tax shelters that come with it, the leverage that you can take advantage of, the ability to use debt, so you really don't need to make all of this money to create all of this, impact to your financial future.
One of my favorite business books is The 10 Roads to Riches by Ken Fisher. It's actually 9 Roads to Riches. The 10th road is the standard: get a job, put money into a 401k, retire at 65, live off Social Security. But of those other 9 roads, you have OPM or other people's money, and then you have be kind of a land baron, real estate baron, whatever you want to call it. But you essentially combine two. You combine the real estate aspect with OPM or other people's money. I have a lot of friends that have rentals, but they're never really rich because they might have 2 houses they rent out. Like they buy a house, then they, get kids or whatever, so they upgrade, and then they rent out the first house. But you're buying 100 units, or something like Robert Kiyosaki, right? Where he's having 5,000 units or whatever. You're basically having the tenant pay the mortgage. It doesn't really matter even if you're making a profit, because you're just then harvesting the money through a cash out refinance years down the road, right?
Yes, exactly. And if you really look at it, rich people don't sell a lot of things. They reach back at those things, access their debt, which is tax-free, to then push into another investment that should generate cash flow that down the road in a couple of years after appreciation, you can reach back at access that debt. So it's a slow game. It really is a slow game in the beginning. It takes time and consistent effort. And, I pinched pennies for a bunch of years. I was really cautious to make sure every dollar I saved, I could then leverage and take advantage of and keep rolling that ball forwards. And yeah, you referenced to a lot of people that have, 1, 2, or 5 houses. And I think very quickly people go from having, specific habits and lifestyles that allow them to invest and take that risk that they decide they don't want to put up with anymore after they accumulate the first couple things. And the question is, how much do you want to sacrifice to get there? And at what point do you just say, I'm comfortable? And you see what you look for over and over again. So, if they decide they're comfortable and they've already looked at what they have and they're comfortable doing that, then that's a great place to be. There's a lot of stress that comes with growing the portfolio and continuing to take that risk. And I think a lot of people I know, after they get to that third or fourth house, they say, great, I can get rid of my job. I can manage these, and I can just not have my job. And then I have my family and my real estate. I'm going to pay these off in the next 20 years. And then I'll go from this much money to this much money. So they're looking at a way to exit without doing any more of the work and taking more of the risk, which there needs to be an appetite for to continue growing.
You have a couple young kids, and I know that you travel with your wife and your children. And I think a lot of it too just depends on lifestyle. Like one of my parents' friends, they have 12 houses that are paid off, but they pretty much manage them. They had pretty high paying jobs. And then as soon as they had all 12 houses paid off, they essentially retired, or their definition of retired. But they really can't go anywhere because they have these 12 houses that they manage, because they don't want to have a property management company or someone come in and manage it and take part of their profits. If you're not willing to take on leverage or more debt or use other people's money, to me, it just doesn't seem like it's necessarily the best. Of the 9 paths that Ken Fisher talks about, it seems like you really got to go all in on this real estate thing to really make it work. Or how do you see it?
It depends on how quickly you want to change your future. So obviously the faster you jump into the ocean, the quicker you get desensitized to the temperature. So it's like how are you dipping a toe or are you jumping in? And the idea of paying something off and having it free and clear, I understand where people come from and why they want to do that. I also argue against it, though. I think it's a really bad move. Somebody falls down the stairs in your free and clear house. Are they going to go after your insurance payout, or are they going to go after that free and clear house? Puts you in a really bad position to have that free and clear asset if you have a renter in there, from the standpoint of protecting it down the road if something bad was to happen. Debt is a good thing. And for a lot of reasons, and the interest payments that you're making, that provide you a shelter at the end of the year to help you keep some of the money that you'd be paying in taxes. So, I don't use that strategy. I don't plan on ever having free, clear, paid off assets. Whenever there's enough equity there, I want to get them back to 65 or 70%, and I want to keep that money working in another way. It makes a lot more sense to me to do that. I understand the other side of the coin as well. I would just disagree with it. And as far as the whole point of why we're doing this, why does anybody look for, out of the rat race? The goal of the out of the rat race, I think, is you have your time. It's your time then. So if you're going to make those sacrifices and get that great long-term job and save up the money to pay off those houses to then manage those houses, you just bought a job for your retirement. I don't want to buy a job for my retirement. That would not be my goal. So I would say to those people that have those 10 free and clear houses, I'd say, cool, figure out a way to buy 4 more houses with the debt from these 10, and the cash flow from these extra couple houses will pay that property manager. And now you went from making, $150,000 a year and spending X amount of time to making maybe $130,000 a year and getting 100% of your time back. 100% of your time is incredibly valuable.
Yeah, I thought the same thing when I was reading that part. And then in that section of your book where you brought up someone tripping and falling, suing you, whatever, and if you have, say, 12 units, then you should have 12 separate LLCs. So that way, instead of having 100 units in one LLC and they sue you, and all of a sudden there's a lot of money in this one particular LLC versus having 100 units and each having their own separate LLC will shelter you from some liability.
Absolutely. Yeah. Separating things is really important. Each one of those is a separate business, a separate thing that, has its own separate risk.
let's just say hypothetically someone had, say, $10,000. How would you start? You must get this question all the time. You got $10,000, $15,000, something like that. I mean, how do you start? That's what everyone wants to know.
Yeah, I'm a young guy in real estate, and a lot of people that I get to ask questions to now, and that I ask for mentorship or whatever, that I get to really brainstorm with. They have larger portfolios than me, and they're much older than me. And it's funny how often I've gotten or how many times I've gotten the question, how did you start? I don't understand how any young person starts today, because when I started, it was the 80s or it was the 70s or it was, whatever. And I was able to lie. It's crazy how many old real estate investors will start with something like, I got my first batch of properties by writing a letter to a bank, and they couldn't verify my credit score, and they couldn't check my Facebook, and they couldn't check my, all of this information is now public. So it is a different approach now than it has been for a lot of these previous generations, because the access to information is right at everybody's fingertips. So you got to be honest. There's no lying about it. If you have that $10,000, you need to start working with a mortgage lender to see what you can qualify in the first place and start learning the game of how to leverage that $10,000. I think an incredible opportunity are these assumable loans. I think if I had that $10,000 right now, I would be looking up pre-foreclosure lists in my town. That's public data. I'd be looking at everybody who has an interest rate and enough equity that I would want to go post their door. I'd say I have, $10,000 to give you, and I'll pay off your back, missed payments and back taxes and back insurance. I'll help your credit over the next couple of years. I want to assume your mortgage. So you can figure out a way to use that money to benefit you without going through a traditional mortgage lender. But it's really nice to start there. Start with a traditional mortgage lender so you get a pre-qualification letter. So even if you are going to get an owner-occupied deal, you want them to know that you're qualified still to work with a bank. That instills confidence in them as well. So the best thing you can do with that $10,000 is get it working. Figure out how to get it working. The money that's sitting there isn't working.
How many units or so did you have before you were able to quit your full-time job? You bought this fourplex and you're working in oil and gas basically right at 23 years old after university.
Yeah, I think I was at, so I had 12 units that were completely finished and rented. And then I had a project, a 16-unit office building that I had bought, and I was converting them to residential. And it was about 2 or 3 months from finishing that project, and it needed my attention. So it would happen faster if I was present versus not present, which was a little bit of a motivator. But yeah, so I really had 12 producing units and then a 16-unit building that was about to finish. And I met with my buddy, a good friend in town who was also in real estate, and told him about, the frustrations I had with existing property manager, because I hired out property management right off the bat to make sure I can make more money working, to qualify for more loans, so I could buy another property. I did not want to spend my time managing the property instead of making money. So I focused all of my energy working. And but I used to, I complained a little bit about her, because of evictions, because of rents not going up, because of inspections not being done, or because of, quality of tenant that ended up occupying a unit that didn't meet the qualifications I gave in the first place. Lots of things, there are lots of touch points, and real property management is really stinking hard. So everybody's going to have frustrations with their property manager. That doesn't mean they're doing a horrible job. Every one of them could do better. There's a lot to it. I was talking to him about my frustrations, and he's had the same, that he was dealing with on his side. And both of us were like, I wish there was a better option. We don't have a good option in this town. And he said, there's national franchises. We should look into a national franchise and learn how to do this correctly. We could do this better, and you could keep more of your money. Could you jump right now and jump into property management? Because that was my long-term goal. When I was first starting my investment career, I thought I'd get to a certain number of units, and then I would start a property management company. I was going to name it Schindelar's Listings. And that's how I was going to exit the oil field, because it was a miserable job in the oil field. My motivation every day was waking up and having to work that job in West Texas or North Dakota or Baggs, Wyoming. These little places that just aren't fun places to be. You're stuck in the middle of nowhere. And that was my motivation day to day, to make sure I got out as quick as I could, learned as much as I could, leveraged myself as much as I could to get there as quick as I could.
Do you think for the average person that real estate route is the most realistic to get to that next level of income?
I do. Yeah, I mean, the crypto space is incredibly volatile. And there's, I think, great opportunity there for somebody to turn their $10,000 into something. A good example would be, we go back to the book and we talk about leverage and simple numbers. Like somebody who was going to jump into Bitcoin today, right? Like say somebody was going to buy, like $50,000. I'm going to buy $50,000 worth of Bitcoin. All right, well then, I don't know what the value of Bitcoin is today, but let's just say they got one Bitcoin. How much would that value of that coin need to change by to actually impact their life? It's a lot easier to spend that $50,000 and impact the life that you're going to have in the very near future with predictable returns than with a guess on the volatility helping you. Yeah, I don't know a better way really to do it. And I'm not the most financially educated person. I've really, really dumped all of my chips into real estate, but I've done a lot of reading and learning. I don't know a better way to do it.
Of Ken Fisher's 9 roads, he's got to become like a CEO, start a company, be a celebrity, marry into it. All those are not necessarily easy for the average person to get into.
Right. Those are, they're great things, but like the fail rate on new businesses, it's horrible. The fail rate on like the possibility of your product actually becoming $1 million product. Read 12 Months to $1 Million. That's such a cool book. And that's a book that like gets you motivated to want to start inventing and coming up with products to create leverage in that way to modify or change something. But once again, there's so much competition. There's so many other people trying to do that. And how are you unique? You don't need to be unique in the real estate market. There's so many properties that can work and there's so much inventory sitting there. You just got to figure out how to become one of them. You don't need to be the one because there's a ton of them. And your neighbor might be doing the exact same thing and they can both be successful right next to each other doing the same thing, having the same model.
You're in the state of Colorado, which has been a net gain state for years in terms of population. How would this differ if you're in, one of these states that are losing people like California or New York or New Jersey or Illinois, states that are high tax, and also California. In the book, I mentioned 10 Roads to Riches. This book was written in 2008, and he's like, don't do this in California. It's hard to evict people. And you saw that with COVID, where people didn't have to pay rent for years, and people are leaving San Francisco, which used to be one of the highest real estate markets in the world. How much of a factor does location have? And what would your recommendations be for that?
Oh, man, incredible factor. And you hit on like the most important metric. Are people moving there or not? It's like you're trying to fill beds. And then the question is, who are you competing with in that market? So yeah, maybe it's not a net gain state, as far as population goes, but maybe they have a huge influx of a certain demographic of people going to a certain place. And that group of people needs to rent things at this price point or is more interested in this price point. And who are you serving? Knowing who you're serving really matters. Location is incredibly important. Somebody said a long time to me that you want to be he's like, I want the trifecta. I always want the trifecta. I want people to be educated in a place. I want them to be employed in a place, and I want them to retire in a place. That is the trifecta. And I think as long as you have 2 of those 3, you're going to be set up in a pretty good spot. You don't want to have one of those 3. A one-legged stool hurts a lot to sit on.
Yeah, I feel like anytime someone talks about a triangle, it's always like the trilemma, where you can have 2 of the 3, but you're never going to have all 3.
Yeah, hard to find.
Talking about my parents' friend again that has those 12 units, he has 12 single-family houses, and he says he never does apartments because he thinks that you have lower quality tenants and have higher turnaround and more issues that pop up with the tenant versus the single family houses. What's your thought on that? Because if you have bad tenants, it could really kill your profit margins.
Yeah, absolutely. No, really one really bad tenant in an apartment building, like corrupts the whole organism. It just spreads, unfortunately. So there's something to be said for the quality of the person that goes in and making sure you have good quality people that move into properties. You're not always going to hit a home run there. You're going to have people that have problems in their lives, and now they have great credit scores, but then they got in a car accident and they went to the hospital and the bill was astronomical. There's always things that happen. And what I really care about is the statistics and using a vacancy rate to my advantage and knowing if I'm going to have to pay a bill or not. And the best way I can protect myself is by guaranteeing that the bill is going to get paid by the resident so that I'm never going to be subject to have to come out of pocket to pay that mortgage. And that math problem really gets more and more important as the portfolio gets larger and larger and larger and larger. It's easy to pay for the one house's mortgage when nobody's there. It's really hard to pay for all 12 houses' mortgages when nobody's there. So, when I look at the statistics of what's vacancy rate in an area, in our little area, we have like a 2 or 3% vacancy rate right now with a huge need for housing. If I have a property that has 4 units, there's always going to be turnover. There's going to be economic vacancy in a single family house, and in a fourplex, people move. The national average, I think, is like 2.6, 2.65, something like that, years for a tenant. So everybody's going to move at some point, or most people will be moving at some point. And I want to know when that person moves out, who's paying the bill. And, in a fourplex, that one person, they can move out, and that's fine because the other 3 tenants are paying the bills. And I know that because what's the chances that I'm going to be managing 50% vacancy rate or a 75% vacancy rate? Now, they're really bad. I have a 2 or 3% vacancy rate. So even though somebody moves out, there's a really good chance that my other units in that building are still filled. So those bills are still paid by the people living there. Those utilities are still paid by the people living there. I know at the end of the day, I have a security there. As long as I do a good job providing a good product at a good price, I'll be able to list it and release it quickly and not have to really worry too much about that turnover because it's going to happen to everybody. It needs to happen. It's important to happen, actually. If it doesn't, then the property doesn't get improved. You don't add all of this additional value. So 3 or 4 years down the road, 5 years down the road, maybe 10, you can go in and appraise it and have them go look at that unit, see this brand new, updated, beautiful thing that added all this equity to let you reach back and grab that debt out of. You don't increase your rent as aggressively on people that have been there for a lot of years. You kind of leave it be. You feel comfortable with the person. They're doing a good job paying their rent on time instead of remarketing it, next year and saying, hey, we have, a 10% rent increase over the year. Maybe you give them a 2% or 3% rent increase over the year, $20, $25 a month, something very small to keep them in their place because they've been doing a good thing for you as well. And when that person moves out, which is a good thing for them to transition, you're going to be able to increase that rent by 15 or 20% back to market rates after you do those improvements. And those market rents are part of what is going to help you get that appraisal. They get the bigger number that also gets you to reach back at your equity. So, the game of improvement and continuing the financing and refinancing process to continue accessing your cash, to continue reinvesting is like this snowball that keeps moving forwards. And I know people who, I have a friend right now that I've been, talking to about real estate for years, trying to help him build a portfolio, assess real estate. Took him a really long time to take the jump. He finally took the jump maybe 3 years ago. He does a creative way of renting houses on like a more of a by the room basis instead of traditional units. But it's been, quite some years. And I think he just actually cashed his first rent check that he was going to keep because every single check has gone into repairs and improvements for all of these years on every single property, on every single unit, for every single month. So he never kept a dollar of the money that was coming in. All the excess money that was coming in just always went to improvements and making things better and better and better. So down the road, next year, he won't have to make those improvements again. And as soon as interest rates hopefully go a little bit, lower than they are currently, he'll be refinancing those things and tapping into them.
How long does it take to kind of reach financial independence with your strategy? In Ken McElroy's book, he says 5 years to be, pretty financially well off, and then 10 years to be kind of more, I wouldn't say FU money, but moving a lot more in the upper stratosphere of high income earners in the U.S.
I totally agree with those numbers. I think, in 5 years, very, very, very possible to be retired and comfortable at the 5-year mark. And then really, even if you don't grow very much from year 5 to year 10, the compounding values and the increasing rents, those, they play a factor in how much spending money you have every month. I think 5 years is a great goal. That's the number I give a lot of people. So I think 5 years is a great time frame, and that's like the goal I give a lot of people. It's like make a budget, come up with your goals, leave them alone for 5 years. It's like the people who say after 2 years and they bought their first 2 houses and they go back to their regular spending habits and they buy their new car, or they quit their job at 2-year mark instead of the 5-year mark, and they suddenly see stagnation. It's like if you can last 5 years and you can continue really plowing forwards in a straight line, you go far.
Your book, The Millennial Map to Millions in Real Estate, I'd say maybe the most important word that you talk about in the book is leverage. And we kind of talked about this earlier, but basically you have good debt and you have bad debt, and debt is a strategy. And if you listen to someone like Gordon Ramsay, he's like, for him, pretty much all debt is bad. Like you're talking in your book and that you mentioned earlier, where it's like, why would you pay off this building? There's so many tax breaks, take out another loan, keep leveraging, buying more buildings, basically. And there's a plethora of other reasons. Just talk about leverage and how important is leverage to your overall strategy?
Man, it's incredibly important. Yeah, I mean, the idea of picking up a big rock, if your financial future is a big rock, how big of a rock can you pick up with your hands? Much smaller rock than you could move, with a crowbar. It's like leverage means a lot, and a lot of people shy away from it and shy away from the debt. And there's a lot of bad debt. There certainly is a lot of bad debt. So you got to get some understanding of what an asset is in the first place. And that's where Rich Dad Poor Dad, really, I think, serves a great value to a lot of people, is understanding what is good debt in the first place. What is an asset in the first place? If your goal is to retire at 60, 65, it's a really smart move to save all of your dollars and not sign up for a bunch of debt. I want to decrease that time by as much as possible by using the resources that are at my disposal instead of just using my time. I don't want to clock in 9 to 5 and use every one of those hours of savings to not compound, just to add on to each other. It's if you look at compounding interest, it's the same idea. It's like, one of the great wonders of the world, says Einstein. It's the amazing thing, but you can compound your efforts and use leverage at the same time and have so much control. I don't really know why you wouldn't take advantage of that. I think everybody who's bought their own home, even if you only own your one single family house that you own, very often people look back and they say, wow, man, thank gosh I bought my home. I love this home. It's added so much value. There's this silver wave of retirees right now, and I don't remember what the number is, but thousands of retirees a week right now until 2030, when the baby boomer wave of retirees ends. And statistically, the biggest asset that group holds is their house, their primary residence. So I think we should look at that as great insight to what we should be doing for ourselves in this generation. And I got a lot of friends who wish they bought houses, 5, 7, 8, 10 years ago that didn't. They've been renting this whole time, and they made enough money to do it. They made enough money to buy it. The couple that bought one wishes they bought 5. The ones that bought 5 say, man, I wish I bought 10. And the ones that bought 10 often say, man, how many should I have bought? It's a hard one. I think leverage makes the most sense, though.
A lot of people just have this fear of debt because you're always told that it's bad. But it's like if you get a 30-year mortgage and you're taking money out with a low interest rate today, that money's cheaper today. So in 15 years from now, that mortgage, even at just standard market rates, you're going to be over doubling what the mortgage is on top of it. In your book, you're not even talking about really appreciating with the times. Yeah. But like, it's, the fact is, would you rather borrow? I mean, what's $10,000 today versus what's $10,000 going to be in 10 years from now, especially since COVID, where they printed trillions of dollars. I think the last time I looked, the inflation was like close to 6% since 2008, since they printed all the money during the great financial crisis in 2007, 2008.
My dad gave me $100 bill when I was 13 years old. It was my 13th birthday party. He gave me $100 bill. I put it in a little piece of plastic. I still have that $100 bill. Yeah, it's like the old one with the little head instead of the big one. And every once in a while, I go through my old things. I see this $100 bill in this little piece of plastic, and I think, man, I could have bought a lot of stuff for $100 when I was 13. Now I can buy dinner for my family of 4. It's like it's crazy the value of money and how it changes purchasing power. When you just look at it through purchasing power and what's happened since 1970, since we were taken off the gold standard. I think, 96% of the dollar's purchasing power against gold has been lost. It's a huge percentage. So yeah, keep the dollars working. Keep the leverage in place. The dollars that sit in the bank that aren't working for you, you're actually losing money because the interest you're collecting is less than the inflation that we're experiencing. So your purchasing power actually is going down. You're hurting yourself by saving money sometimes. Now, how much money do you have to make extra to make up for that lost value of what you have in the bank?
There's a lot of different asset classes of anything. You get to be talking stocks, bonds, whatever, but then there's just a lot of different asset classes within real estate itself. You'd be talking commercial real estate, or you'd be talking residential, or maybe you're talking like casinos or resorts or hotels, whatever. And you kind of focus a lot on residential. Then we were talking just about leverage. I mean, leverage goes both ways. Leverage allows you to borrow other people's money and to amplify your returns, but you can also amplify your losses if you're stuck in a housing crisis situation in 08. So how do you mitigate the potential downsides of taking out this debt to keep scaling up your residential properties?
You partially hit the nail right on the head when you said it earlier on. It's like in the book, it never talks about appreciation. That's that cherry on top. You never even want to factor it into the equation. Don't think about something that's going to be worth in a couple months from now. You think about what rents are going to be worth now. Like the goal is cash flow today. The goal is cover your payments today. And rents might fluctuate a little bit. They're not going to fluctuate a ton. How much inventory would need to come onto the market for rents really to drop through the floor like values? Something, I've never seen. I've never seen rents just drop off very substantially. And I don't know what would destabilize the inventory to cause that to happen in the first place. So you're totally right. You could be upside down. But did you lose any money if you didn't sell it? You didn't lose anything. You're buying time and patience. The idea if that person is making your payment, even if you're not making $1, even if it's just covering the payment, because you have 1 or 2 vacancies in this 4-unit property. So it's only just scraping by and making its own payments. It's still making its payments and it's buying you that time. So you get to take advantage of, long-term asset.
He talked about Maslow's hierarchy of needs, and shelter is at that base. You're always going to have a place to live. Assuming it doesn't turn into some like San Francisco situation where people are fleeing, people are always going to need a place to live. So you'd have to have a pretty unpredictable and mega catastrophic event. But like you said, if you sell it at a loss, well, that's one thing, but you're not flipping houses. You're actually in this for the long term. It doesn't matter if the price is up 5x or down 5x because the rent's pretty stable. I always find it funny when people like talk about a stock and they're like, oh, it's up 30% today. It's like, that'd be like you going on to Zillow and checking the price of your house every day. What difference does it make to you unless you plan on selling it? But it's like, same thing with Bitcoin too. But you don't go into Zillow, oh, okay, oh, my house is up 10% today. I better sell it, like whatever.
It's a really funny thing that you mentioned, crypto in that space as well, because I agree. Like, how often are we looking at, what holdings we might have and looking at the volatility and thinking, oh man, I made a bunch of money. But did you sell any of it and actually take any of the money? Did you actually make any money? Because you don't have any of that money to spend. You're not, it's like, you see that volatility and you see that value increase. And I think, oh man, it's pumping. I should dump some more money into it. And actually, sometimes it costs more at that point because of the emotions that come with it, instead of realizing, hey, well, I could spend that now. I could do something with it. And that's the value of it in the first place, is to use it.
As you start making more money, one of the biggest ways to increase your take home is with tax mitigation. And real estate seems like it's one of the better strategies because, like you're saying, you're never actually really paying these buildings off or these units off. And as the equity gains, you basically then do a cash out refinance. So it's actually in the form of debt. So you're never really paying taxes on that. We live in Puerto Rico where we have Act 60 and other programs to shelter taxes, which is why people move here. But you don't actually have to find some fancy accountant or do any trickery like moving to Puerto Rico or the Bahamas or BVI or something. In your book, you write, the tax code has been drafted specifically to incentivize our economy's growth. So work within it. And real estate is really one of the things that's working within it.
Yeah, we have an incredible need for housing. We need investors to come in and provide affordable housing for other people. We need it. So tax code's trying to incentivize it to happen. You said you don't need some fancy big, accountant, but I kind of disagree with that. You need somebody who specializes in what they do. And somebody who specializes in real estate tax law is valuable to your team. So that's different than an average CPA. There's a lot of tricks. Your passive losses from this one building, do they apply to your entire portfolio or do they only apply to this one building? There's like little important factors that add up to a ton of savings. So you really need to know real estate tax code if you're going to be dealing with a big real estate portfolio.
So how low would, for an average real estate investor's effective tax rate be at the end of the year? Are you talking like low single digits in total or even less than that?
Yeah, low single digits or even less than that, depending on what type of property you have and how much depreciation you have and what type of properties. And obviously, we're talking about income tax there, but you pay a lot of property tax. And so you're not getting rid of all of your taxable burden at all. You're just shifting it from one type of tax to another. And sometimes you have to buy something realizing a loss, and you'll take that loss because you know it's going to shelter the income you made here. So it's going to actually help you in a couple of years from now down the road. That's where strategizing really makes a big difference with that CPA.
Yeah, because you can roll over that for what, like 5 years or something like that. Isn't that correct?
Mm-hmm.
But yeah, I guess as you're going in, buying these properties and making them better to increase the rents, you're also increasing your property tax. Colorado, where you're at, is one of the lower property tax states. It's not like you're in California or Hawaii, one of the higher ones.
Yeah, time changes things. I've seen our taxes double in the last 4 or 5 years, and it's becoming less and less advantageous to be a landlord here in Colorado. I know a lot of people who are liquidating their portfolios here and moving to other markets.
Yeah, last time I looked, I thought Colorado had the third lowest property taxes, but then also Colorado has higher property values. So I guess if you got to factor that in as well.
Yeah.
You didn't mention anything about Airbnb, but I was interested on your thoughts on the Airbnb. I lived in a lot of ski towns in Colorado, and a lot of these towns are passing ordinances and not allowing short-term rentals. And you have a lot more headaches when you have people coming in and out. But what do you think is the future of Airbnb? Do you think we're going to see a lot of municipalities tightening the regulations on this?
Mm-hmm. Yeah, I think they're going to start getting taxed really heavily and being treated more like hotels to even the playing field. I really like the idea. I love staying in Airbnbs instead of hotels. It makes all the sense. I didn't like running them. We tried running a handful of them, and it's like getting another job. Do you want another job or not? And I got into my industry so I could try to avoid having another job along my time. And so there's something to be said for doing Airbnb. I think it's an incredible opportunity for a lot of people to maximize the income when they only have a couple of units. And the maximizing of that income then can help them qualify for a loan to grow faster. And then once they get to whatever number they need to, they can go back and revert all those to long-term rentals. And now instead of making 150% of what you were expecting, you're back to 100% of what you're making. But you got 100%. You got your time back. So using it as a tool to grow, I think is a great thing for somebody to do early on. And then even later on, if you really wanted to keep it as an Airbnb and you didn't want to do the job, I think the huge advantage is finding the Airbnb host. So finding a super host and saying, hey, you're doing a great job. You're a super host, which it takes a lot of work to become and manage and maintain super host status. But that person then is obviously very qualified and they're doing a great job running their business. Maybe they would want to take over your Airbnb and rent it at a higher rate just to allow you to sublet it so they can continue doing their job because they have a job they want to do. That's how they got into being a super host in the first place, probably. They likely don't own the property they're Airbnb-ing. There's a good chance they're renting it already and subletting underneath of them. So it's an opportunity, I think, but it also could be an incredible hindrance to your freedom.
Yeah, I mean, basically, it seems like you're picking up another full-time job, which is what you're trying to avoid in the first place. Are you noticing in Colorado any more inventory coming onto the market that are former Airbnbs, where people are just like, I just don't want to do it, or are they just then converting that short-term to a long-term rental?
So in our area, no. Our Airbnbs are staying Airbnbs because we have our Palisade in Grand Junction and Fruita, I believe, all require you to have a permit to be an Airbnb, and they've been pretty aggressive about limiting the number of those permits available. So there's like these huge waiting lists for people to have their property become an Airbnb property. So, but no, we don't really have that here. I'm in a smaller town, which plays a factor, but no, we don't have a lot of our Airbnb inventory transitioning to long-term rentals. A lot of people keep that job after they have that job because it's doing good for them and they can avoid their typical 9-to-5 by maintaining a text stream with these people and maintaining a conversation with their cleaning people and their maintenance person to go, deal with that headache.
I think most people that don't actually own units would be surprised when in your book you basically say that you're only profiting about $300 per door or per unit above cost. Like, you can't just buy any particular unit. You got to be methodical and analytical about it. How do you go about figuring this out?
So my goal is to buy it when I'm buying it to be at about $300 a door. And that's how I run my numbers to make my offer in the first place on that property. So now I open up a PITI payment calculator. PITI payment stands for principal, interest, taxes, and insurance. I figure out what my payment's going to be on that property. I work up what my overall other utility costs are going to be on that property and I try to come up with a worst case scenario that gets me to what my overall liability is going to be every month. And then I assess what those rents are. Try to see if I can get close to that $300 per door per month. And that allows me this wiggle room to do additional repairs that I'm not going to foresee. So my goal always is to break even at least when I'm buying that property. Hopefully I'm making $300 a month. But when that water heater goes out, you're going to use 4 months worth of that $300 cash flow to replace that $1,200 water heater. You want to make sure all those bills are covered. And if there's not some cash flow, some excess cash flow, then you're probably going to end up coming into your bank account occasionally to pay some bills.
Yeah, it seemed like to me, if I understand this correctly, that $300 extra is basically just going to go back into capital improvements. The money you're really making is when you do the cash out refinance and pull money out down the road. Is that correct?
100%. Yeah. So that $300 a month is improving and repairing and going into this little slush fund. So when this person vacates on year, 2.65, that the excess cash flow is going back into that property for the improvement, for the appraisal. So on year 5, you're going back to reach back into it. It's rolling snowballs.
Rolling the snowball. In the book, I forget exactly, I didn't save the quote, but basically it was something like, don't let a few early bad tenants scare you off. Do you have any horror stories of bad tenants, or is that just an overarching saying of landlords?
No, it takes a while. Hopefully it takes most people a while to get their first just horrible circumstance, but it comes, it comes. And unfortunately, sometimes it comes more than you want it to. Even if you do great background screenings and checks and stuff, people's lives aren't always as consistent as you'd like them to be, and stresses make people crack. And I've definitely had a couple big issues. I had a young child, like a 10 or 11-year-old kid who was staying with his grandmother, play with some matches and burn down part of a fourplex really early on when I was investing. There's nothing I could have done to screen for that. That was just a bad, unfortunate scenario that happened. And it was a blessing that nobody got hurt. It's like the best thing that could happen, the fact that nobody got hurt in the first place. So, yeah, you take your bumps and your bruises, but you keep on driving forwards. And when the car runs out of gas, fill it up with gas, keep going. Get to your destination.
My dad, he never had 100 plus units, but he had quite a few. And I think he said he had 0 problems with tenants his first 12 years. He even had original tenants after this 12 years. And then he just had another 10-year stretch where it was just awful tenants. And I'm from Wisconsin originally. In the state of Wisconsin in the wintertime, you can't evict people, but basically between November and April. I just remember being traumatized. I never wanted to do real estate because I was always over there when I was a kid working on painting walls and hauling out trash. I was like, man, I never want to get into real estate.
Yeah, no, there's a lot of people with that similar story. They watched somebody or they have a friend who did and they heard, but you always hear the bad. You hear the bad a lot more than you hear the good, unfortunately. That's true for everything. It's really hard to get good reviews. It's really easy to get bad reviews because bad stuff sticks with you for a long time, irritates you. But you don't think about that waitress who did a great job next week. You do think about the steak that looked like trash that you bought anyways, and you made a recommendation to your friend to buy and he bought it. You feel guilty for it. I don't know. For whatever reason, it's really easy to dwell in the bad. It's really hard to dwell in the good. And that comes down to real life and every day as well, and being happy. It's really easy to focus on your frustrations and your stresses, and it's pretty hard to see, wow, it was a great day. It's a great day today. It couldn't be much better. It's really hard to say that.
Yeah, when I was reading the book, it just made me think for you scaling up, because if you scale up, then you basically have a property management company, which my dad never had. And so he had to deal with all these issues personally, or in the case of these remodels with me as well. You basically got your first unit already hired a property management company, so you could go and make more money and do your own thing. And I think that for a lot of people, they'd be better out. Like you're saying with my parents' friends, hey, maybe have 15 units instead of 12 and then get that property management company.
Absolutely. Yeah. Value your time. How much is your time worth? Maybe write that number down. Figure out how much you're paying that property manager. If she's making less than what your time is worth, you definitely shouldn't be doing it. You should be earning dollars. Every dollar you earn is something you're going to be able to leverage there with a property, with a loan, something, as long as you keep moving.
There's a famous realtor saying, which is basically you make the money. I forget exactly how it goes. There's something like you make the money on the purchase.
Yeah, you make your money when you buy.
Right. And then in your book, you basically say you disagree with that. But that's assuming in your case, you're not looking to flip these houses or time the market. You're looking to have a long-term rental and have that cash flow for years. Mm-hmm. Can you explain your philosophy and explain that real estate cliche?
Yeah. So you make your money when you buy it. If you were to buy in 2006, but I was still in college, so I didn't have to go through the cycle. I'm a little too young for that. So didn't learn from this experience, but I know plenty of people who went through it and had these conversations. And people who bought in 2006 and 2007 that bought a house with the expectations of improving it and selling it, they got burnt. And they got burnt, pretty bad because they had to sell it. They didn't have another exit strategy. They weren't in a position where they could try to keep the thing and cash flow the thing, take advantage of changing the market that was going to come years down the road. So, the people who bought in 2006, though, that bought for cash flow, they experienced some hardship. They definitely lost some value. They were in the red, the value of the house versus what they purchased the house for. But the cash flow didn't get affected nearly as much as the value. So they were able to cover their payments still, which is all that mattered. So that by 2012, they were able to then be able to sell that property and recuperate all of their money or make a profit. You don't lose money until you make an action that forces you to lose the money. Time is what I was really talking about in that portion of the book. And I'm a young guy, so like my goal has always been, how many properties can I accumulate to then take advantage of, when I'm 60 or 70, when I'm an old man. I want time. Time is on my side. And if you look at the chart of values, a graph of values showing what appreciations look like for the last 100 years in America, it seems like a pretty valuable set of data to refer back to. And we're not looking at short-term trends. We're looking at long-term trends, which make me feel more confident.
Yeah, like you said before, basically the rich people, the billionaires, they're doing the buy, borrow, die. They're never selling. And then they put those assets into a trust or foundation, pass them down to the children. You don't realize gains until you sell it, but you also don't realize profits until you sell it, like you're basically saying.
Yeah, losses come that way, and profits luckily come without selling it. Profits can come down the road with additional debt. Yeah, you don't lose anything in that scenario as long as you're really investing for cash flow.
You have a website calling Living Unconventionally, and you have some different type of schooling techniques. Like you do a lot of traveling with the kids. What are your goals? You've got all these properties. You got independence, which is what people strive for, and you're doing it in your 30s. A lot of people don't figure this stuff out until they're 50, 60, whatever.
Yeah, so I can't take credit for living unconventionally. So that's my better half, Cassidy's project that she's been working on for a long time. And she's been a lover of travel forever. I'm kind of been a workaholic for a long time. I've been planning for retirement since I was like 12. I've had a lot of businesses, but a bunch of them, little things fail, through high school as well. And so I've been planning to work towards a retirement goal for a long time, for freedom of time. And I have a brother that I wish I was, closer with. He's back in Baltimore. I'm here in Colorado, but he's disabled, but very high functioning and a great guy. And I always kind of thought I would be taking care of him and helping him out later on in life, which I think is probably why I started all those businesses young and had that motivation to figure out money at a very young age. As I've gotten older, I've realized the value of my time and what's really important. And where we were talking earlier on about choosing to focus and dwell on the stress versus happiness. And I try to really focus on my happiness, and I realize that comes with being with my family and spending time exploring and doing things with them. So that's my big goal, is to have control over my time and to make an impact on my community and do a bunch of nonprofit work that I think is really valuable for the long term. And I can now focus on the things that I'm interested in instead of focusing on the things that just make money, which was a large, it had so much of my attention for such a long time and so much of my energy for such a long time. You miss out on a lot of the good things that are around you. And I said this a long time ago to somebody. There was a rabbi that I was talking to. I was in Israel at the time, and we were talking, and he was talking about impact and improving other people and helping the people and how that's like the source of happiness. And I told him, man, this was like 6-7 years ago. And I told him, man, I am embarrassed to say it, but I am selfish. I am not doing those things. I am not helping a lot of other people. I was like, I work 120 hours a week. All I think about are my bills and my expenses. All I think about is what I can save. And all I think about is like how I can take control of these things in my life. And it's me. It's selfish. I have a lot of really selfish goals. And he looked at me and he said, you can't make a big impact on anybody else if you're not selfish first to improve yourself. How full does your cup need to be before you can start filling other people's cups? It's like if your cup was only this full, you can only give everybody a drop, and nobody's going to live off that. So I thought that was really like a valuable thing that he told me. And it's really about compounding your interest to be able to improve something so that you then have these resources to make more of an impact, to improve the things that maybe you really care about. That's been my goal.
Yeah, you can't save others until you can save yourself. So if you're talking about working 120 hours a week, how many hours a week are you working right now?
Yeah, I mean, in my real estate space, just on my units, it's probably 5 hours a week, something like that, on new projects and on dealing with the problems and issues that come with those projects, maybe another 5 or 10 hours a week on top of that. And then for the other things I want to give my energy to, whether it's, when we travel, I can teach a class with my kid, at whatever school we're putting our kids in. That's something that, we've really tried to think about is what's the traditional educational system and how do we want to educate our kids? How can we make an impact in their lives now that we maybe didn't like about how we were raised? I can now spend the time focusing on things that I think are going to be valuable to improve their upbringing and lives. And then I'm probably going to go back to grinding and working my butt off as soon as they get to the middle school and high school ages. So I'm really eating it up right now while they're little and taking control of my time. It's hard to say how many hours I really work because it all is based on problems. If there's a big problem, I'll go to my office and I'll be there for 5 or 6 hours for 5 days in a row and deal with that problem until I can resolve it. Sometimes that problem doesn't arise for 6 months and I get to work on that 3 to 5 hour schedule every week on my portfolio and focus my energies on other things until that problem arises. It's kind of all over the place.
And you said that you get a lot of people like ask you questions. What are some of the common questions that people ask you that we haven't discussed today?
Yeah, I mean, a lot of people ask about property management, whether they should be using a property manager or not. They ask, if they had X amount of dollars in the bank, how should they be using it? What type of properties would I be looking for? And what areas would I be looking for those properties? They ask for questions in regards to building out their pro formas and their expense sheets to make sure the ARVA that they're making is got to be something that cash flows for them, so they're not going to be too risky. Typically, they're very broad questions, though. How do I get motivated to do this? Where should I cut some costs to make sure that when 2 years from now, I can get into this type of property? It's surprising how many people don't look at their own numbers and don't realize how much money they spend every month. They look at their bank account and they know they only have X number of dollars, but they don't really look at what they're spending the dollars on. This is a great example. We went on a trip and we met some friends on our trip and they were frugal. They were like, hey, we're not going to eat out breakfast with you guys because we're going to try to go to lunch here with you guys. We're not going to buy a dessert tonight because tomorrow we want to be able to rent this. They're making financial decisions on the spot. They make the trip affordable. And then, we were talking about things one night and I told them, we've been traveling. This is a 3-month trip for us. So we canceled our Netflix. We canceled our Disney. We canceled all these subscriptions and all these things that we weren't going to use for 3 months because we're going to be traveling. There was no reason to waste the money on them. And they're like, we have all those things. We have all of these subscriptions. We have a lot of these subscriptions we don't even really use, but maybe once every couple months, and we're paying for them every month. Why? Why would you do that? What a waste. And it's because it's mindless. It's so easy to set up on something for auto pay and have it sitting there waiting for you so that when you want it, it's there, but you don't need it all the time. So why are you paying for it all the time? So just being more understanding of what your own life costs are and expenses are and where you're being wasteful.
Right. My parents are retired in Panama, the country, and their Netflix doesn't even work in Panama. They have to get some other plan that's 3 times more expensive. So even if you have the subscription, it might not even work when you're traveling anyways.
Yeah, absolutely. No, it's funny. Some countries you go to, though, and you realize, wow, when we log on to Netflix here, it has all these shows on it and all these movies we don't have in America. It's like there was this, I don't remember what show it was, but we were in Colombia at the time. I see your shirt. And I remember we were watching a show in Colombia. It was Suits. And it wasn't on our Netflix when we got home from that trip. And we just thought, we should have finished the show while we were in Colombia. It's like, we only watched a couple episodes of it because we don't spend a lot of time watching TV, hardly ever. But it was a unique situation. I think it was Christmas time or something there.
Yeah, I was in this Spanish immersion school in Costa Rica for 6 months. And I was watching the Disney Channel for kids, but there was a lot of shows that were filmed in Argentina. And I learned Spanish really well that way. But then when I got back to the U.S., I couldn't watch any of those shows. But those shows were good because the vocabularies, it's words that you'd use every day. What is it, the average person only uses 500 words a day? But then they're also really animated. Mm-hmm. So because they're animated, you can kind of figure out what's going on. Like, oh, like, like Isabella is mad at Roberto again, but you can kind of figure out like what's going on because they're so animated. But I was like, I got back to the States and I was like, man, like my Spanish is going to suffer now.
Yeah, it's funny. So I do like podcasts, Spanish podcasts, and I have like wireless headphones. So I kind of like, I don't know, my little life hack. I always try to be taking in information and be efficient with my time. And efficiency matters a lot to me in all kinds of different ways, not just financial. And yes, I wake up in the morning, I pop in my little Bluetooth ear pod that's waterproof, and I start my little Spanish podcast, like a children's book about a mystery. And I get in the shower, I'm listening to this podcast all the time. So while I'm showering and brushing my teeth, I'm practicing and learning my Spanish right then. And like just thinking about your time, how valuable your time is to really take advantage of your time. What can you get out of it? There's all these little things that you're wasting, little pieces of your time and your days is one of those things you're wasting.
I read about 100, 150 books a year. I think I probably mentioned this before, but in your book, you mentioned that you listen to a lot of audiobooks, and, it's kind of, again, you're talking about being efficient. You can drive around and listen to a book. And Ken McElroy, he also mentions that it's important. But what are some books that you would recommend? Doesn't have to necessarily be related to real estate, but what are some books that have really impacted you that you would recommend?
Man, Man's Search for Meaning by Viktor Frankl. Have you read that book?
I have read that one.
Wheelbarrow Profits. That's a really cool book that talks about scaling and understanding what can you do with leverage if you continue moving forwards, and looks like a lot of real good real life examples. I like statistics, and I like thinking about things in like a causational way. I think Malcolm Gladwell is a great author for that, like Outliers or The Tipping Point. Some of those books are really cool for just your brain space and like how to think about problems and problem solving. Really staying current. I think the very valuable thing is staying current. So maybe not listening to a ton of books that are old, but maybe listening to podcasts and things that are current in current market and current environment, because things change quickly, So, really like maybe finding the right type of content that you want, finding the right podcasts and circulating through things that are very current, be some of the most impactful things you can do after getting that foundational base.
I go in different stretches. I have a Kindle, so I take a lot of articles. I will convert an article, I'll save it into a PDF, then I convert that into a Mobi file to put it into my Kindle. I always try to read at least an article a day while I'm reading books, because I think you're right. But also, I love to read books that are like 100 years old. Human psychology never changes, and the human mind never changes. So it's interesting. I'll read some book from 100 years ago, and you're like, man, you could have never guessed that it was written 100 years ago. You would have thought it was written like yesterday when you read it. But some stuff is just timeless, but other stuff is like, well, you got to kind of stay ahead of the trends or understand. So I think it's good advice. And that's where podcasts are maybe more current than books.
Yeah. And even when I listen to a lot of like my, finance-based books, I look at what year it was published, and I want something that was within the last like 5 or 7 years. I want to try to absorb as much current content as possible. You're right. Foundational and, psychological things. There's a lot of things that, are timeless. You look at the 10 Commandments, right? Like, you're supposed to rest for a day. It's crazy to think almost 3,000 years ago, God said, you work a lot, rest for a day. Just give yourself a day of being with your family. It's like, yeah, we're all inundated and we all are busy. And that's like my kind of my pet peeve, something I've been working on for a long time. I talk all the time. I just love to talk. And when I see people and I say hi, I ask how they're doing always. And everybody wants to say, how are you doing? They say, oh, I'm busy. How often do you get that answer instead of, oh, I'm doing well, or oh, I feel good, or oh, I'm full. I just had a great lunch. And like the go-to answer for so many people is busy. And it's a choice. Happiness is a choice, and like how you use your time is a choice. And yes, we're all busy, but you can still be happy while you're busy.
So Scott Schindelar, author of The Millennial Map to Millions in Real Estate, Small Changes That Create Life-Changing Wealth and Freedom, has joined us today. So I just want to thank you for spending over an hour with us today. Scott, I just got 2 final questions. Where can people find you, get a hold of you? And then secondly, is just leave us with a final thought.
You can find me, look at my book and read it and ask any questions you want. I love to answer questions. And there's an email address in the book that you can reach out to me and ask those. It's like millennialmap2millions@gmail.com, something along those lines. Something that I'd like everybody to kind of take away on their day is the idea that the dollar and the number that we all seem to look at in the bank all the time, that the number when you log in at the very top, if you were to go to the bank and ask them to give you that money, they don't have it. This fractional reserve banking, they're just creating an opportunity to lend, and they really don't hold a ton of that money in the bank, and you think it's sitting there, it's safe and it's comfortable and it's waiting for you, but it's not always just waiting for you, and it's not always just sitting there safe. It's losing value. So take control of your money, take control of your future and your financial well-being, and make a plan that doesn't involve just sitting in an institution for somebody else to then take advantage of and loan out and leverage, because that's what that bank's doing.
You talked a little bit about like crypto and Bitcoin in your book. Are you a fan of Bitcoin then? Do you like having these alternative asset classes?
Yeah, no, I think crypto is the future of money. I'm very pro, crypto, and I think it's a huge opportunity for people right now to jump into, from a volatility standpoint, from an investment standpoint. It's too volatile for me to speculate and to look at on a regular basis. I can't quite handle it. It's like, I don't know, it's like going to an all-inclusive resort. I can't stop eating, I don't know if I don't just have like the mental fortitude to just say, no, I'm not going to do this, at this price point. But, I just see graphs that are all over the place. I want to jump and I want to act, and I always want to like change my plan. And it's something in real estate where I can't really do that. I make a plan early on, I commit to making a move. I don't finish, it doesn't finish until it's at the end. And I can't really change paths once I make that choice. I'm full steam ahead. And that doesn't really give me that same forced requirement in the crypto space. So yeah, I have not focused a ton of my energy or resources there. I try to ignore it altogether. So whatever I do have, sits in a wallet, and I try to not even think about it being there.
My dear friends, that is it for this episode of El Podcast. Once again, if you're not yet subscribed, please subscribe on YouTube as well as Rumble. You can also find us on Spotify and Apple Podcasts, or wherever you get your podcasts from. We thank you all from the bottom of our hearts for watching and listening, and we will see you on the next episode.